Okay, good evening, everyone. Again, welcome to another episode of Sequoia Training on Commercial Lending. We talked about a lot of different products for the last 4 weeks, and hopefully you attended our training. We invited various different type of Sequoia advisors to come on board to talk about different products. So Eric talked about 1 to 4 unit. Melissa pretty much, go full force on the all type of commercial lending that we can do, ranging from, a few $100,000 all the way up to hundreds of millions of dollars. And then Juliet was here, talked about the factoring. And of course, last week, we have Terry right here talked about cost segregation and all these product right there. It's good too for you to go out there to talk to your clients, for you to, regardless what business that you are in. Many of these tools can actually help you to open up the, to break the ice, start talking to business owners. So today we are going to switch gear a little bit. We are not going to talk about any particular product per se, but what I would like to share is how can you filter out these clients? Because for the last few weeks, we have tremendous amount of new agent came on board to us. Understand that many of us are new to commercial lending. All these products are good, but how am I going to, what do I need to watch out for? What are the basics of commercial lending? What are any of the rules and guidelines that I need to know about? So hopefully by tonight's presentation, I can share with you, I can share with you some basic that you can watch out. So when you go out there to talk to your client, you can apply these rules to when you try to filter out the client, so that you can identify what is workable and what is not workable. So today's topic, we're going to talk about the rules of the game in commercial lending. Okay. Now, first thing first, we are commercial lending. We are in commercial lending. Now, however, we are not a lender. I see a lot of people out there on Facebook, Twitters, whatever that might be, marketing yourself, saying that you are a lender. No, we are not a lender. So please make sure that it's very, very clear. We are just a loan consultants. We are not even, we're not even a loan officer, because once you use the term loan officer, people automatically think about that, hey, you need to get licensed and you are doing residential primary residence and things like this. That is not what we are, okay? We are not a lender, and we are just a consultant. We do not have our own money to fund. A lot of people are asking us, hey, Alan, does Sequoia is a lender? Does Sequoia fund any deals? No, Sequoia does not fund any deal. But however, we do have a lot of investors trying to partnering up with us and ask us to become a lender. But I don't want to become a lender. We might be in the future, but again, at this point, Sequoia does not want to become a lender. Okay, so that's the one thing. We are not a lender. We don't have our funding. We don't have funding. We don't have interest rates. So many agents or even clients came to us saying, hey, Alan, what is your rate? What is Sequoia's rate? Can Sequoia do this? No, Sequoia does not have any interest rate. We are a broker. All right. So all the interest rate came from all the lenders that we work with. Okay. So basically, our job is to connect the right product or the right project with the right source of money. If somebody needs fix and flip, we are out there pulling the fix and flip lenders. If somebody needs working capital, we pull in working capital lenders. Now, what do we do? One thing that we do is that when we receive all these scenarios, we evaluate the deal. We want to make sure the deal is workable. We need to out there to collect information. Now, I just saw a post on Facebook and saying that, hey, why are you guys asking for so many documentations up front, so on and so forth? It is because really depending on the type of loans, okay? We do need to look for some basic information, some basic documentation. Now, if you're just talking about purchasing a real estate property, things like this, initially, I don't need any documentations. You can just fill out the 1 to 4 unit investment property scenario form for us, make sure all the numbers are correct. Then we can provide a rate and term. We don't need any documentations. However, if you're asking for business loans, if you're asking for working capitals, if you're working for equipment, now this type of loans, we do need to look for documentations. Why? It's because without knowing the business finance, there's no way for us to provide any rate and term. There's no way to even for us to tell if that deal is durable or not. So again, as a broker, our job is to evaluate the deal. And once the deal is a workable deal, then we will pull in the right lender. Now, when I say the right lender, again, we have so many different lenders. So just for example, like equipment loans, we have at least like 15, 20 lenders that can do equipment loans. So based on the type of equipment, based on the type of the client's profile, now we know which lender that we go to. So for example, we just had an approval for a client who owns a home-based business where he sent out nurses to different to patients' home, and she needs to purchase medical equipment for her business. So some lender does not like that industry. They just do not fun, right? But however, we do have other lenders that can do something like this. So again, that is what we do as a broker. So please, we try to ask for the minimum number of documentations. If the client is ready to get the loan, most likely they already have those documentations ready. For example, if they're looking for a working capital, for any working capital, we normally would ask for tax return, profit and loss statement, and bank statements, right? So those are the very minimum informations that we need to ask for. Now, if they don't have something like this, most likely they can go to their CPA, go to their tax accountant to get something like this. And if they cannot provide anything like this, I would rather find out upfront than, we spend so much time in evaluating deal and then come out, ask them for some documentation and end up they cannot provide the documentation to us. So that will waste everybody's time. Okay. So again, that is, first of all, we need to understand we are not a lender. Okay. The second thing we need to find out is that we are not an investor, meaning that, hey, we do not put money, we do not invest money, and we do not work with any investors that can invest in projects. So oftentimes we have agents come up to us saying that, hey, Alan, I got this client right here, got a great idea. Got a great idea and they can make so much money in the future, yada, 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 and they need funding. They need investors. So in that case, when you talk to your client, and if the client telling you that, hey, I have this and my future is this. So basically they are actually based on their business on the future performance. No lender would do that. Only investors. If this is a good idea or is a good project, investor might come in and give them the money. Now, what is the difference between us and an investor? Investor, when they put money into a project and if the project failed, that's okay. They lost the money. That is what investment is all about. Okay, you make money together, you lose money together. But we are not an investor. We are what? We are a lender. Okay. So we provide funding for businesses that is already in operation. So make sure that you understand. If somebody come up to you and talking about all these different kind of idea and things like this, we do not do that. Okay, so those are the two things, very, very important. We are not a lender. We are not an investor. Okay, so with that being said, let's jump into the rule of commercial lending. So the rule of commercial lending, normally we have something called the 5 C's. If you understand these 5 C's, pretty much you know how to filter our client. Now, why do we need to do that? It's because, yes, the Sequoia platform is set up so that you can fill in, you can bring in whoever that you want to bring in. We can evaluate a deal for you. That's not a problem. But as you are come into the business more and more, and you stay here longer and longer and longer, you would like to learn how to filter out your client also. So think about this. Whatever comes in, obviously whatever comes out. If a lot of the deals that comes into the pipeline, comes into the system, is not a workable deal, obviously it would not have anything to come out at the other end. So that will discourage you or discourage your team member. So it is very important for you to at least understand some basics before you put them onto the platform, right? So first thing first, we're going to talk about these 5 different things, and we're going to go into detail. So the first thing is obviously collateral. Yes, everything need to have collateral, okay? We oftentimes have clients come up to us saying that, hey, Alan, are there any 100% loan? In some case, yes. For example, like equipment, we can fund up to 100%. But other than equipment, there's no such thing. It's 100% loan, especially when you come into real estate. You're buying a mixed use apartment building, so on and so forth. There's the no 100% loan. And also, collateral, it's what the lender is lending based on. Okay. Anyway, so we talk about collateral. That's the first thing. So the first thing that you need to ask your client is that what kind of collateral do you have? And now if they're purchasing a real estate property, that is a collateral. If they are looking for equipment loan to purchase an equipment, the equipment is the collateral. Now, if they're looking for working capital, their business is collateral. So every single loan got to have collateral. Okay. Next thing is obviously we need to talk about, it's the cash flow and capital. Cash flow and capital of the business, or the cash flow or capital of the principal of that project. The next one is we talk about, it's the character. The character of this client. Character means experience. What have they done? What kind of experience that they have. The last but not least is obviously credit. Okay, so those are the 5 C's that normally any lender would look after. Of course, there are so many different variations to it, right? Sometimes people will say conditions of the property, that's another C, so on and so forth. But anyway, so those are some of the basics that we need to understand. That's what we're going to talk about tonight. So collateral. Definitely collateral. Let's talk about collateral. That is how the lender feel comfortable when they give the funding. The first thing that we always need to learn to ask is that what kind of collateral? What are you trying to do? Somebody come up to me saying, "Hey, I need $1 million to fund a commercial property." Now, then you know that the commercial property is going to be the collateral. Ask them, what type of commercial property is this? Is it a single family home? Is it a residential property? Is it a mixed use? Is it an apartment? So on and so forth. Okay. So now, also I also hear people come up to me saying, "Hey, Alan, yes, I have collateral, but for example, some people will come up to me saying, "Hey, Alan, I have a lot of antique. Can you use that as collateral?" I would say 99% of the time it's not. I had an agent this morning came up to me saying, "Hey, I have a client that has some painting that worth millions of dollars." Yes, it might be true that painting worth about millions of dollars, but you have to understand one thing: when the lender is not in the business of to take away your property. Okay, the lender is in the business of what? Is in the business of lending money. So if you tell them that, "Hey, I have a collateral, I have a painting that worth about $1 million," the lender in his mind is that, what am I going to do with this painting? Yes, it might worth $1 million, but if I cannot cash out, that painting to me worth nothing. So the lender, remember one thing, team, that lender is not in the business to foreclose your property or to take away your collaterals. They want to lend you the money to see you become successful so that they can get their money back plus their interest plus their fee, whatever that might be, and they can continue on to do their business. So we need to, depending on what type of collateral. Now, most of the time, the lender's looking for the following collateral. Number one, obviously, is real estate collateral. Okay. Now, real estate, we all know real estate have its values. Now, this value, a lot of time, this value is actually based on personal opinion. Even though you have an appraisal that came out, it's basically just a personal opinion, right? So many clients will normally evaluate their property higher than expected. So they have this mixed use building right here. They come back saying that, hey, I think my property worth about $3 million. And you ask them, where do you get the $3 million from? And they might tell you that, hey, that is what this neighborhood is selling for. They're selling for X dollar per square feet. And my neighbors, has a similar property sold for $3 million. And I believe that my property worth about $3 million too. Okay, well, again, that is their personal opinion, right? But from the lender's perspective, they don't look at that way. They look at, obviously, they need to send out an appraisal to look at what that value, what is the true value of the property. And sometimes they might want to do two more than one appraisal. So for example, if you are talking about a multi-million-dollar property, $10 million, $20 million property, sometimes they would like to do two appraisals to make sure that the value is there. If sometimes they don't do two appraisals, they might do what they call evaluation. They will hire another third party to verify this appraisal is correct. Okay, so there are so many things behind the scene that we need to know about the collateral value. Now, even though, let's say the value came back at, let's say, $3 million, whatever that might be. Now, from the lender's perspective, the lender's not going to give you 100%. No lender in their right mind will give you 100%. In today's market, if you're talking about commercial properties, when I say commercial property, it means that there's no residential portion. Warehouse, retails, self-storage, so on and so forth. So this type of property, approximately between 60 to 65% LTV. So if the property worth about $1 million, maximum that lender feel comfortable to lend to you is about $650,000. That is what it means. Okay. Now, if you are talking about has the residential component to it, now the LTV can be higher. If this is a single family investment property, you can go as high as 80%. And that's it. So again, that it's how the lender will feel comfortable. And sometimes the lender, it's all based on their comfort level. Now, of course, they also look at the environment. They also look at the area. If you have a multifamily in the middle of nowhere versus a multifamily in the middle of New York City, now obviously the comfort level is different, right? So now the lender is going to lend you differently. Most importantly, the lender, when you talk about commercial property, the lender is looking for something called cash flow, okay? Which is we're going to talk about in the next C, is talking about cash flow. How much money can this property generate? How much money can this property generate? So obviously, the more income generated from this property, the more comfortable the lender will feel. So let's say, again, the same exact property right there, worth about $3 million. It's a warehouse. Now, what would you think if you were the lender today? If you were the lender, you got all the money, and I come up to you saying that, hey, John, I got a $3 million warehouse right here. And Bobby next to me also saying that, hey, I got a $3 million property right here, right next to Alan's $3 million property. They're exactly the same, look exactly the same. But here's the difference. Alan, my property is vacant. Okay, my property is vacant. Bobby's property is fully rented and generating $30,000 a month. Now, they're all $3 million, hypothetically, okay, all $3 million. Who would you lend to? Who would you lend to? I bet you will lend to Bobby instead of Alan. Why? It's because now Bobby has what? Has that property generating income and coming in every single month. So you know that property can actually support the loan itself. So what is that called? That is called DSCR, debt service coverage ratio. Okay. Now versus me, Alan, exactly the same property, $3 million, but that property is vacant. Now, as a lender, you would think about, hey, if you lend me the money, how am I going to support the loan? Right? How am I going to support the loan? So again, cash flow is the first thing that everybody will look at. Every lender will look at. So a lot of people will say that, hey, oh, well, my property worth about $3 million, $4 million, $5 million, whatever it might be. If I don't pay, you would just take away my property. No, it doesn't work that way, because it's pain in the butt to go through foreclosure. We all know that. And I just mentioned, the lender is not in the business of taking your property away. They want to generate income. They want to make money. The last thing that they want to do is to foreclose your property. Okay. So that is why when they doing the underwriting, they want to see what kind of collateral you have and how comfortable I feel about that particular collateral. Okay. Now, also, we have agent come to us saying that, hey, yes, the property worth about $1 million. And you lend me, Alan, you lend me 65% of it. That's fine. Can I have a second lien that somebody give me 35%? So you give me 65%, I have a 35% second lien on it, total 100%. Your risk, Alan, or your lender is still 65%. Can that be done? I would say the chance for that getting done by actual lender is very, very slim, because the lender do not like to see you over leverage. Basically, right now in this case, you're 100% leveraging, which means what? Which means that as the principal, the client does not have any risk or whatsoever. If something happened, the client can just walk away. Yeah, you can foreclose my property, do whatever you want. You walk away. They can just easily walk away, and all the risk is it's on the lender's shoulder. So the lender does not want to see that. They still want to see you as the principal have money in the game. So another thing that you need to ask your client is that, do you have any capital? That's what that C stands for. Do you have any liquidity? Right? So this is $1 million property right here. How much can you put down? And if somebody telling you that, oh, I can only put down 10%, forget it. Most likely that deal cannot be done. Okay, don't even mention something that sometimes the client will tell you that, hey, what about seller financing 35%? You lend me 65%. It's not going to work. Now, some lender do allow second financing, which means that the lender give you 65%, and the seller give you a percentage, let's say 5%, 10%, whatever that might be. But even in this case, the lender still want to see the client have money in the game. So normally it's between 10 to 20% that the client needs to put in of his own money into the deal in order for the lenders to feel comfortable. So it is very important for us when we go out there to talk to our client, what is your liquidity? How much money do you have? And that is why when we collect documentations, especially when somebody is talking about $10 million, $20 million purchasing apartment buildings like this, we always ask for something called personal financial statement, PFS, personal financial statement. Okay. Now, in business loan, most lenders do not look at their personal tax return. We don't care. We don't look at it. But we do look at this PFS, very, very important. So the PFS is the client telling the lender, what is my liquidity? How much money I have in the bank? How much money I have in stock? How much money I have mutual fund? How much money I have in, trading, whatever that might be. How liquid I am. Okay, so that's liquidity. That's the first thing that the lender will look at. The second thing the lender will look at is their net worth. Now, net worth is How many property do you have? What is their equity in the property? Now, though equity, you cannot take it out tomorrow. Okay. Or you might not even be able to take it out unless you sell the property, right? But they still want to see it. They want to see what kind of net worth you have. They want to see what kind of client that they're dealing with. So this is very, very important, because the higher the net worth or the more liquidity the client has, the more comfortable the lender will feel. Now, again, why is it like this, right? So let's say, give you an example, let's say construction loan. Construction loan, they will give you a 12-month period of time to build a building. Let's say they give you $1 million. Now, once they give you the $1 million, starting next month, you will need to start to pay them back on a monthly basis, okay? So while you're building that building, we all know that that building is not generating any income. You still have to put money into it. You still have to support the loan, so on and so forth. So the lender is going to ask, how are you going to support the loan? So that is why they want to see your liquidity. If you don't have anything in the bank and you are going to ask for $1 million, it's very difficult. Now, we see a lot of cases that came in, people was asking for 10 million, 20 million. But when we look at their financial statement, they're saying that, oh, I only get $10,000 in the bank. How is it possible that for any lender will release any fund to you or to that client if they only have $10,000 in the bank? It just does not make sense, right? So that is why a capital, it's very, very important. So learn how to ask these questions when you talk to your client or anybody that present a deal to you. Okay, so that's what we do in the back end. Every time when we talk to our client, if you pay attention, for those of us who been through the three-way conference call with us, one way or the other, or one form or the other, we always ask the following questions. How much money do you need? What do you need the money for? How much money can you put down? How much cash flow this property can generate? What is the rent roll, right? So again, we ask for all those terminology that is for us to understand the cash flow and the capital of that particular client. So that is very, very, very important for us to know. For us to know. So it's also important for the lenders to know also. So now, in some cases, let's say, literally, right now we have an example that the client is actually building a house. He has been using his own money to fund the project. And he thought that he can complete the project using his own fund. But halfway through, he's almost complete, but now he ran out of money. He came out to us to asking for funding. So now when we look at the project, that gentleman already spent like $2 million into that project, his own money. Now he's only asking for about $700,000 to complete. And when we look at that bank statement, literally, he doesn't have anything. Why? It's because he literally used up all his funding, all his own fund into that project. He put all the money into that project. So we understand. So now in this case, we know all the money is actually in that project. And that project, let's say he put in $2 million into it, but the value of the project is more than $2 million. Now, in this case, for the lenders to give him $500,000, $600,000, $700,000, it's pretty normal. It can be done. But the lender, because he has no money in the bank, which means that most likely has no ways to pay for the mortgage. So most of the time, in this case, the lender reserved 12 months of interest. What does it mean? It means that, let's say they give them $600,000, and let's assuming that every single month the payment on that $600,000 is $2,000. Just an example. So now in this case, they will reserve 2,000 times 12, which is $24,000. They will reserve $24,000 in the lender's escrow account. So the lender will use that money to pay for the monthly payment, so that in this case, the client does not have any pressure to pay the monthly payment every single month while he's finishing up the construction. So in that case, we can, build something. We can construct a loan like something like this. But regardless, cash flow and the capital is also very important. Now let's get back to the cash flow a little bit. So many times when you look at a building, a lot of the, if you using a traditional ways to look at a building, a lot of people just thinking, oh, fine, yeah, this building worth about $5 million, $2 million, etc. But in reality, when you go out there to do an appraisal, especially in commercial lending, they will provide two studies. The first thing is what they call the as-is value. As-is value. So the building right here, let's say it's an apartment building, has 20 units, okay? The 20-unit building only rented out for 50%, and the other 50% is still vacant. So that is as is. So basically means that this particular building right now is generating 50% income. It's not at full income yet. Does it make sense? So now this is as is value. Now, of course, they also do a study called stabilization study, meaning that, hey, what if this property, the 20 units, all rented out at market rent? What would be the value of that building? So that's two numbers. Now you can see, ask yourself, what would you, which one would have more value? The as-is value or the stabilized value in this particular case? Obviously, the stabilized value, because when the property is generating full income, the value of the property increase. Does that make sense? So that is why there are two different values. So how do you determine the value? It's based on cash flow. So many times the client, they don't understand. When the client come to us saying that, hey, my building worth about $3 million. How come you can only fund me 40%? I want 70%. How can you only fund me 40%? It's because that building only rented out for 50%. So we cannot use the stabilized value. We can only use the as it is value, or use whatever the cash flow of the property is to determine what the loan amount is. So that is very, very, very important. Now, same thing, let's say business loan, okay, working capital, okay? So for working capital, you might ask, what is the collateral in this case? The business itself is the collateral. So that is very important for us to understand how long have they been in business? How long have they been running their business? If somebody come up to you saying, hey, I just started up my business and I need $100,000, the chance for that is very, very slim, unless they already have some other business that they are extending their business, or they're open up another shop. There might be a possibility to give them $100,000. But if somebody that out of school, that have no experience whatsoever, and he has an idea, and now he wants to open up a pizza place and asking for $100,000, most likely this is not possible, because again, there's nothing for the lender to hold on to. Versus if the pizza place has been in business for the last 10 years and in the same location, and they are generating $30,000 a month, every single month consistently, now to the lender, that business is a collateral. It's a good business. I'm willing to fund the business. Okay. So I still need to look at the what? Cash flow, right? I still need to look at the cash flow. I want to see how much this business is generating every single month. So that is why a lot of the people come up to us saying that, hey, I mean, I want $100,000. I want $300,000. Yeah, that's fine. You can want whatever you want, right? You can always have wish. I wish I can get this. You can wish. But the reality is that how much can that lender, how much can that client get is based on the cash flow of that business. And that back to my first question, earlier, when we talked about what do we do? When we look at the deal, we need to collect documentation, is because a lot of the scenario came into to the system. People are asking for all sort of number, and people are asking for 10 million, 20 million, but they are, the monthly income is only $3,000. Ask yourself in the right mind, if somebody only making $3,000 a month, is it even possible for you to give them 10 million? No, absolutely not, right? So that is why we want to see numbers. Okay, so that is the cash flow, and that is the capital. The capital is that, hey, for business that does not, for business, we want to see what the debt schedule is. Okay, how much debt they have. They might already have other loans, or they already have some equipment loans or SBA loans or business loans or credit cards, whatever that might be. So we want to see what the debt schedule looks like for that particular business. So those are the important things. Those are the rules. Without knowing anything about commercial lending, at least you need to learn how to ask the right question. What kind of collateral? What is your cash flow looks like? What is your credit? What is your capital look like? Okay. So now those are the 3C already. Let's move on to the 4th C. It's called a character. So character basically means that experience. What is the experience of this client? What kind of experience that they have? Can they demonstrate that they're able to pay back loans in the past? So on and so forth. So let's talk about real estate. When you talk about real estate, in many scenario form, we always ask, how many investment property does this client owns? Now, that is very important. The reason that we ask, especially on our side of the world, the more investment property that this client has, the better the rate and term would be. Now, if you will go to a traditional loan officer, okay, and if you have one property, you might get the best rate. But now when you start to have 2 or 3 properties, now your interest rate actually goes up. Why? It's because on that side of the funding, they look at something called DTI, debt to income ratio. Now, whose income? Not the property income, your personal income. Okay, that is why they qualify the client as a person. Most of the time, the client only have what? A job. And now they're doing investment out there, investing in property part-time. So their income is limited. So let's say they make $100,000 a year. So when they purchase one property, they have a mortgage. The mortgage, again, is the debt to income ratio. That is a certain number. Now, the more property that they purchase and what happened to that DTI is getting bigger and bigger and bigger. And so at the end of the day, they might not even, most likely, they won't be able to get a loan from a traditional loan anymore, from a mortgage company anymore. Okay. But in our side of the world, we reward our client. The more property that they have, the better the rate and term would be. And they have a lot of advantage. So give you one example. Let's say 1 to 4 unit investment property. Somebody that wants to purchase a single family home for investment purpose. So if this is the first time that you're purchasing it, most likely the lender will only give you 70%. You have to put down 30%, right? But now if you have a few more properties, now you can go all the way up to 80%. Okay. Now let's talk about DSCR. DSCR, if the DSCR is 1, meaning what? Meaning that the property is not making money, but is not losing money. DSCR stands for debt service coverage ratio. Means that how much the property can generate divided by the property's expense equals to 1. So that expense, including the mortgage, including tax, property tax, insurance, whatever that might be, okay, equals to 1. So when you equals to 1, DSCR equals to 1, that property is not making any money. Now, if you're not an experienced investor, means that this is the first time that you're buying a property, they might want to see the DSCR for 1.25, okay? Now, if you have a few property under your belt, they're okay with 1. If you have 10, 20, 30 property under your belt, some lender is willing to drop that DSCR from 1 down to 0.75%, meaning that even though that property is losing money, but because you have experience, the lender will still lend you money. So that is what happened on our side of the world. So experience is very, very, very important. Now let's talk about construction. Okay, let's talk about fix and flip first. Fix and flip. And another example, right? A lot of people, it's a type of investment. A lot of people out there purchasing fix and flips. Now, again, if you do not have experience, can you get funding for it? Yes, you can still get funding for it as long as the loan is less than $500,000. A lot of the lender will still give it to you. But once it's above the $500,000, a lot of lenders not feeling comfortable to give you that money without experience. So if you don't have experience, normally they will give you up to 80% of the purchase money. So for example, let's say you buy a property for $200,000, you need $100,000 to fix it. So total cost is what? Total cost is $300,000. So if you don't have the experience, they will give you, let's say, 75%, maximum 80% of that 200,000. So you have to put down, 20, 30% into a fix and flip deal. Now, if you have experience, on the other hand, they can even give you all the way up to 100%. Yes, I do have lenders that can do 100%, but again, you have to have a lot of experience. Okay, a lot of experience. So in this case, what happened is that you need to show the experience to the lender. Depending on the experience level, they will give you, whatever the loan amount would be. So experience is very, very important. So that is fix and flip. Now, same thing with construction. What happened with construction? Construction, I'm talking about ground up construction. You buy a piece of land, there's nothing on it. Now you're building a brand new house. It's from nothing to a house. Now that is totally different than fix and flip. Especially lender will need to see your what? Will need to see your experience. Without experience in today's market, most likely you're not going to get a loan. So in that scenario, that client has to partner up with somebody who has experience to come into the deal together. Okay. Same thing with purchasing multifamily. Same thing with purchasing other investment properties. So again, the more experience you have, the better the rate and term would be. Now, especially when you go up to $10 million range, above $10 million, now they're looking at two things. They're looking at experience. They're looking at what? Liquidities. The more liquid you are, the higher the net worth you are, the more experience you are, the better the rate and term would be. So again, that is just give you an idea what the lender is looking for. Now, what about some business loans? I don't own a property. Same thing. They want to see your experience. So let's say somebody come up to you saying that, hey, I own a business. I own a piece of place. I own a trucking companies. For some reason, for the last 2 or 3 weeks, we have a lot of inquiry about buying trucks. Okay. So now you need to ask them, how long have you been in this business? Now, ideally, if they have been in business for 2 years, that is great. That is, most likely we can get them some funding. Now, if they only been in business for 3 months, 6 months, 7 months, it's very difficult for us to give them any working capital. It's just because they have no tax return to show. Working capital based on tax return. Now, in that case, we can only look at their bank statement for the last 3 months, 6 months, whatever they open up. Can we fund it? Yes, we can still fund it. But again, the rate and term is going to be ridiculous. It's just like a credit card loan. It's what we call a cash advance, right? So based on the income, the last 3 months of deposit, we can give them 10,000, 20,000, but the interest rate is like 18%, 20%, 30%, sometimes even get up to 40%. So you can see the more experience you have, the better the rate and term that you can get. And also, same thing with trucking, right? Also with people that are saying that, hey, I need to go out there to purchase a business. Ask them what kind of experience do you have? If they run business before, and now they want to open up another one, a new one, great, fantastic. We do that all day long. Okay. Now, if they are purchasing franchise, that's another story. If they're doing franchise, they don't necessarily need experience because, again, the franchise is going to come help them out and help them to go through the process and things like this. So, but regardless, character, business, time in business, and number of property owns, those are all experience. Okay, so the more experience that they have, the better chance for them to get the loan that they want. So it's very important for us to out there when we talking to the client to learn how to ask some basic questions. So those are all the things that we ask on our end. Okay, so understand one thing: the more you filter, once you talk to them, and this is what I always tell everybody to do, right? A lot of people asking us, hey, can you do this? Can you do that? Why can you not do this? Why can you not do that? Put yourself in the lender's position. Assuming that today you are the lender, you have that 20, 30, $100 million in your pocket, and somebody come up to you and asking you for funding, and you don't know them. Just by looking at the number, just by looking at the criteria, looking at the collateral, looking at the cash flow, looking at the capital, looking at their character, would you fund this project? Ask yourself, right? And if you yourself do not want to fund this project, most likely the lender is not going to fund it, right? So that is the way for us to learn how to filter out, because the more you filter on your end, now the lead that comes in become more quality into the system. And the more quality lead into the system, definitely you have something to come out on the other end. And that is how you actually make that big bucks. So that it's a character. And last but not least, okay, last but not least, it's credit. Yes, credit is very important, especially when you're talking about deal that is less than $10 million and below. Everybody look at credit. Now, I understand a lot of the business owner out there have challenging credit, which is fine. Okay, but that is very important for them to protect their credit, fix their credit, pay attention to their credit, protect their credit, so on and so forth. And that is why we have a service on our platform that help our clients to protect their credit, fix their credit. All right. So why you don't, we understand. Because from the lender's perspective, they don't know this person. They don't know who they are. That personal financial statement, you can make it up. You can put in whatever number that you want to put in, right? If they, if the lender cannot verify this, you just put in some numbers. So the only thing that the lender can verify at the beginning is credit. They want to see what kind of credit this person in, and once they understand the credit, they have a pretty good understanding what happened with this client. Now, when we talk about credit, we're not just talking about the credit score. We're talking about a credit profile. Somebody come up to me saying, hey, I have 700 credit score. That's fine. But the lender will still like to see the credit profile, which means the full credit report. Why? They want to see, do you have any bankruptcies in the past? You could have bankruptcies in the past, and then now you got out of it and your credit score goes up, which is fine. No problem. But the lender wants to see the history, right? They want to see what causes the bankruptcy. They want to see, do you have any mortgage late in your history? That is a big red flag for any lender. If they see any mortgage late, that is a big risk for them. Same thing. If somebody has 500 credit score, they've got a reason for it. Now, from our side, the lender is willing to work with all credit as long as they make sense and as long as the story can convince the lender why. For example, we have a client that has credit score of 500, but the reason that he has 500 is because he has his son as the co-signer of car loan, car payment. So the son's supposed to pay for the car payment, but he's the co-signer. But then end up the son is not paying it. He does not know anything about this, and the car got possessed, and now his credit got all messed up. So when we look at that credit, it's like 500 something. But again, he's able to provide explanation to the lender and so on and so forth. So the lenders make the exception, but obviously the rate and term would be pretty ugly. But we're still able to get the deal done, right? So in the commercial world, our lenders' main business, as you know, it's lending money. They want to lend to all possible deals. Even though the deal is ugly, even though it's not as good as it sounds, or even though it's very challenging personally, credit-wise, whatever that might be, the lender will still willing to work with you As long as the project makes sense, as long as the story makes sense and it's convincing enough, they will lend. But those are the basic rule of thumbs that we as a loan consultant right here in Sequoia, we need to learn. We need to learn how to ask our clients. So recap, what are the 5 C's? Collateral, cash flow, capital, character, and credit. So those are the 5 things that we all need to know and learn how to ask our clients. Okay. So it's another episode, it's another hour. So I will stop right here and open up the floor for any possible Q&A. So thank you, guys.
Thank you very much for the information. This is Edgar. I got a question for you real quick in reference to a new flyer that was put out on a Facebook page in reference to refinancing existing equipment, I believe. So I can recall that. Can you elaborate some more on that program?
It's a pretty simple program, just like what it is. So that it's a refinancing or cash out on truck and heavy equipment. So the way it works is that, hey, let's say a trucker has an 18-wheeler. He purchased that truck 2 years ago. He paid it off already, for example, and now he needs working capital. Okay, so now he can bring in the truck, and the lender evaluate the truck and evaluate what the do an appraisal on the truck and what the market would be, and based on that information that the lender is going to fund based on the value of the truck or that piece of equipment. Okay, so just that's simple. So just submit a working capital, submit a truck and heavy equipment scenario for us review. So obviously they need to provide the detail of their truck. What is the model? What is the VIN number? What is the mileage, engine size, so on and so forth, so that the lender can do the evaluation.
Thank you.
Alan, hi, this is Cheryl Hubbard. How are you doing?
Hi, Cheryl, how are you?
I'm good, I'm good. Quick question. I have a client, and I was going to submit it today to you, but I just wanted to ask some questions first.
Sure.
That has a restaurant that had to close during COVID. Actually, they opened like December 31st, and COVID hit in March. So they were shut down. So now they have started the process of reopening the restaurant. They're bringing in about $40,000-$50,000 a month only on their evening service. And now they want funding to go ahead and open the catering and the lunch crowd. My thing is, how do we package that up because of that big gap in the business?
So they closed.
Yeah, they had to close
COVID, and then they closed it for 3 years, and now they started up again.
They opened up, I believe, during the summer, so like June or July to now.
So it's less than a year.
Yeah.
So again, this will still be a startup. So from the lender's perspective, whatever you close before, it doesn't count, right? I mean, a lot of people like that, so it's pretty understandable, right? So there's no doubt. So now what
they have experience, they have other businesses, so they have business experience. So I'm just having trouble how to package this because of this scenario.
Well, there are many ways that we can see if we can give him the funding, right? So the first one is obviously we need to look at the if they want to get funding based on the restaurant, so we can only look at the not the tax return, but the profit and loss statement and the bank statement. So based on the deposit, then we can see what type of funding that we can give it to them. So most likely in this case, we can only give them what we call the cash advance. Now that is going to be very, very expensive for them if they really need it, right? Now, of course, we can break it down. We can also ask them what exactly do they need the money for. If they say, hey, I need the money to purchase equipment for the restaurant, now we can get into equipment loan. Now, equipment loan is a lot less expensive than working capital. So in that case, you submitted equipment scenario. We want to see what we want to see an invoice from the dealer. What equipment that they purchased?
Kitchen equipment. Yes, some of it is.
Yes. So that will be a lot easier to get funding for.
Okay.
Right. So now, or another way is that you mentioned that they have other businesses. So we might be able to cash out from other businesses and look at the other businesses tax return and see if we can give them a working capital for the other businesses.
Okay.
Right.
That's
Okay.
good. That's good. Keep going.
Absolutely. Keep them coming. Okay. Keep them coming.
But you don't do any, it sounds like you don't do any micro loans and you're not involved in any of the small business loans like the SSBCI programs at all.
No, yeah, SSBCI, it's a no. Well,
State
again,
program.
SSBCI is a state program
State programs and
that they do.
CDFI programs, any of those
Yeah, I mean they don't want broker like us to get involved. But with that being said, we actually signed a contract with one big lender in California. That, as a matter of fact, right now they're testing out the SSBCI program.
Yeah.
Once they open it up, then we can fund SSBCI in California.
Just in California, yeah.
Right. Or
Okay.
any other state that lender can do. But in other states, I see a lot of other states is not going through the lenders to fund something like this. So
No, they're going through special
Yeah.
nonprofits and CDFI. So
right. But again, if you know any contact, let them know that we have the ability to help them to generate deals.
okay, I will. I mean,
Yeah.
that's what I do all day. So
Absolutely. Okay. Thank you, Cheryl.
thank you.
Anyone else? Feel free.
Alan, this is James.
Hey, James, how are you?
Good, good. Can you, I came in a little late, so, and I couldn't find this thing for nothing. But on a startup, what do we need to show on a startup? You need a business plan, of course. What else do you need to show for a startup?
Well, for startup on our end, it's very difficult to get a loan without any type of collateral. But let me step back a little bit. Okay. Now, when you're talking about startup, there are many different types of startup. So on the most extreme of the balance, let's say somebody just fresh out of college, no experience whatsoever. And now I want to I want to open up a pizza place. That is startup. That kind of business, most likely we cannot fund. Now, however, with the same exact person come to us saying, hey, I want to start up the Pizza Hut place, a pizza place. But I have a few investment properties that has a lot of equity in there. So now we can take the equity we can cash out the equity and use that as collateral or use that as working capital for the client. Okay, so now they can use the money to do whatever they need to do.
Well, let me give you a scenario I'm working with. I got a gentleman that had a business, matter of fact, he had 5, 6 restaurants, and ended up having to close them. He's been working as a GM for a while, but he wants to go back into opening his own restaurant again. And so, but he doesn't have really any collateral right now at all. He's got a low credit score.
Right. So again, for something like this, the only way the lender can fund you is based on his personal income. So he has to show personal tax return for the last 2 years as a GM of a restaurant, whatever that might be. And now definitely the experience show. But how much can he get is based on his personal income.
Okay, gotcha.
Right.
Thank you, sir.
So if you're saying that his credit score is not that good, I would suggest you to help him to fix the credit first.
Okay,
Yeah.
Roger. Thank you, sir.
Yes, sir. Anyone else?
Hello,
Yes, ma'am. Who is this?
Dewana.
Hi, Duana.
Hi. So what about business acquisitions? I saw that on there. Would that qualify if someone was wanting to do a business acquisition, and wanted to use the business's income, to fund the loan? How do we have lenders for that?
Yes, business acquisition. Okay, so let's say John is buying a gas station from
Okay.
Mary. Okay,
Mhm.
so now again, we look at two things, right? Number one, we look at cash flow, right? Remember cash flow.
Mhm.
So whose cash flow are we looking at in this case? Mary's gas station, right? I want to see. So Mary's saying that, hey, I'm going to. John is saying that, hey, I'm going to buy this gas station for $2 million. Fine. How do you determine this gas station worth about $2 million? So now we need to look at Mary's cash flow for that gas station for the last 2 years, balance sheets, profit and loss statements, so on and so forth. Okay. So
Okay.
that's the first thing we need to look at. We also need to look at John's cash flow. So John, what are you doing right now? John's saying that, hey, I'm a police officer and I just retired and now I just want to get into this business. Can I do that? Okay, fine. Okay. So I need to see, John, I need to see your personal tax return for the last 2 years as well. Why? Is because once you purchase the gas station, Mary can make $2 million a year does not mean that John can make $2 million a year under the new management. Am I correct saying that? So if he's not able to generate the income, how is it going to support the loan? So the lender would like to see his personal tax return, personal cash flow, right? So that's the cash flow. That's the first C. The second C that we need to look at is what? Character, experience. The lender is going to ask John, now you purchase that gas station, who is going to run the gas station for you? John saying that I'm going to run it myself. So they saying that, do you have any experience? John saying that, no, I don't have any experience, but I have a partner who owns 10 gas stations that coming into this deal with me. No problem, right? So again, can we get this thing done? Absolutely. But always go back to the last C that we just talked about, right? So now we talk about the cash flow. We talked about the character.
Okay.
Yes.
All right. Thank you.
And as a matter of fact, we just funded a Cold Stone franchise for a gentleman that just got out of military. Okay, just got out of the military. So when you look at the first C, cash flow, no problem, because he's not buying it. He's joining that franchise. So the franchise gave him a lot of proposal, performance, and things like that. Show the lender that, hey, with this location, what is the expected income? The lender's okay. That's the first thing. Now, what is the second C? Character. Experience. Now, in this case, he is purchasing a franchise. Now, franchise, we all know franchise have their own team to help them to get through the, all the trainings and support them and things like this. So he does not necessarily need that experience because, again, the franchise is going to help him out. So again, the lender is feeling comfortable about that. So we funded him about $350,000 to open up that Cold Stone.
Okay.
Okay.
What about e-commerce?
What about what?
Like e-commerce stores?
What about that? What is the scenario?
Would that be like Amazon, a cosmetic line or something that already is in existence that they're selling and it's got a good profitable cash flow? It has a positive cash flow.
Yes, we fund that all day long. So e-commerce. So again, give you another example. We funded a lady that is in some sort of multi-level marketing company that is selling vitamins. Okay. So she purchased a lot of vitamins and she shipped it overseas back to her country to sell it over there. So every single month, she purchased a lot from the MLM company and shipped it back to her country. Okay. So now she needs more money at that time. She need more money to purchase more product. So we, again, look at the first C, cash flow. We look at the last 2 years of her tax return. It works out. We looked at the character. She has been in business for like 15 years. No problem. We funded her. That's not a problem, right? Right. So now e-commerce, you ask a very good question. E-commerce is that you cannot operate the business in your basement. You have to have a commercial place to store the products. So we funded that lady. I forgot about 200, 300,000. I forgot. But her downline came to us and asking for her downline doing the exact same thing. But the only difference is that she has a warehouse storing all her product and she works over there. But the downline stores everything under her basement, in her basement. So in that case, we cannot do it.
Okay.
So we advise the downline saying that, hey, why don't you go out there to get a warehouse, sign a lease, and then you come back to us. In that case, that we can fund you. So e-commerce, same thing. They have to have a commercial place to store their product.
All right. Thank you.
Yep.
Hello, Alan. Benny.
Yes, sir.
Miller.
Who's this?
Benny Miller.
Hey, Benny. How are you? Yes, sir.
Good. Question on the Sequoia platform under the real estate and businesses entity. When you put in an application, they always have a minimum credit score. Like for real estate, 650, for businesses, 600, I believe. So what you're saying is with 500 different business partner, lending partners, that's not really true if someone has a credit score below what you have on that platform. Am I correct?
No, it's not. Okay. So if you are purchasing a real estate, we can do no credit. We can do 400 credit. We can do 500 credit. But the question is that, can they put down the down payment? So for example, let's say we done one 2 years ago. A gentleman filed bankruptcy. A gentleman is actually in bankruptcy. Yes. So his credit is tank, like 400 some credit score. Okay. But he has a property that worth about $500,000, all paid off. Okay. And we still able to get him a loan of 30% LTV. So we're still able to give him $150,000. But the interest rate 2 years ago, if you remember 2 years ago, the interest rate is at what? 3%, 4%, right? If you have a good credit score. But because of the credit, he's in foreclosure, we still able to give him that money, but the interest rate at that time was like 8%, 9%, if I remember correctly. That was very, very high. But we still able to do it, right? So the reason that we want to see the credit score over there is because we can identify what type of client are we talking about. So if you put a 600 credit score right there, we know there's a lot of lenders we cannot use. We can only use a certain type of lenders.
Okay. Okay.
Okay.
Okay.
But they got to be prepared to pay high interest, high fees, and But
Okay.
yeah,
but the bottom line, still submit the application.
Again, if they need the funding, yeah, absolutely, absolutely,
Okay.
right.
Alan, what credit,
Alan.
Company would you suggest that we pull the actual credit profile from, not the credit score, so that you can
Okay.
see the whole thing? Because I would rather see it before I submit it to know what we're dealing with.
Yes.
I
Now,
typically use like IQID or FICO. Is that?
yes. So very, very good question. A lot of people are asking us, do we soft pull? Do we hard pull? Things like this. The best thing for the clients to do is to pull credit score themselves. Now,
Right.
if you ask a third-party company to pull it, regardless where you go, the credit is going to get affected. But if they go to any platform, myfico.com, creditkarma.com, free credit score of freecreditreport.com, so on and so forth. And if they set up an account over there and pull their own credit, there shouldn't be any, they will have any effect. So my suggestion is, because again, every single platform, they pull in information differently. Personally, I would suggest the clients to use myfico.com,
Right.
because myfico.com pull in a lot of information where Credit Karma or other, or even the bank do not pull in. So,
yeah, that's why I suggested FICO. Just go to FICO and get it because they're more accurate. And
yes.
then a lot of times,
Right.
IQID. Those are the only two I pull from. So
Correct.
okay.
Correct. Yes. Thank you.
Hey, Alan, how you doing? This is Dupree.
Hey, Dupree, how you doing, sir?
Good, good. Just to kind of formulate my question, it has a couple of phases to it, but if I ask this right here, this will kind of figure out if I can ask the rest. Do we fund non-stock incorporations?
Do we fund non-stock incorporations?
Yes.
I would think that as long as they have an EIN number, we can fund. What type of business?
Well, it's actually a congregation, a church.
Oh, so it's a non-profit organization.
No, it's a non-stock incorporation. They didn't go with the 501c3.
Did they file tax?
Yes, they
Okay.
do file taxes and they do have an EIN number.
Okay. Well, I mean, if they file taxes, we should be able to do it.
Okay. All right. So my question is, formulating the loan itself for a board/congregation, how would you formulate the loan? Does it come under one person and then maybe co-signers?
What is the loan for? What do you
The
need?
loan is actually for purchasing a building and then rehabbing it.
Okay. So in that case, then the church need to let us know what is that how are they going to help title for that property? So if the church is the one that is holding the property, then obviously, you know, on the church, you have the pastor, you have the elder, whoever's, you know, on the board that's supposed to sign for the church. Those are the people that need to be responsible for the loan.
Got you. So it could be, the loan could be built with a few of the leaders.
You need the operation agreement.
Yeah, you need operation agreement. Yeah, absolutely. So whoever's in operation on that church.
Got you.
Right. Okay.
Thank you.
Yes, sir. I see Helen been raising her hand for a while. Helen, please unmute yourself.
Hi, Alan. Thank you
Hey.
for this excellent training. I
Sure.
got a question regarding your equity share program. What is the requirements? Because I know the 12 states that we're in, and I don't know if we added any more. But in regards to that, is a credit score needed? Will they look at the DTI? How is that? Give me a little more detail on that program.
Okay. Let's talk about the equity share. Okay, so this is how it works. Equity share is not a loan. Okay, so the investor, the lender, or the provider, or whatever you want to call it, will come in, put money into this property together with our client. So just imagine John and Mary buying the property together, invest in the property together. So that is what the relationship is. Okay, so let's say now in this case, John owns a property. It could be a single family home. It could be investment property. I don't care. Now let's say the property right now worth about $500,000. And he only owed $200,000. And he need $100,000 to do whatever he needs to do. Okay. So now the investor will look at this particular property for the last 10 years. Okay. For the last 10 years, how this property has improved in value, has increased in value. And based on that model, then they will project this property will increase to a certain dollar amount in the next 10 years. Okay. Now, once the model is set, they will come out with a proposal to John saying that, okay, fine, now you need $100,000 right now, which is approximately 20% of your $500,000 home. Am I correct saying that? So $500,000 right now, 20%, that's $100,000. But giving you $100,000, I'm not making any money. So I'm going to add my portion to it. So they will come to saying, okay, I give you $100,000. The agreement is that in 10 years, for the next 10 years, there's no payment, no monthly payment, no fee, no nothing. You use the money to do whatever you wanted to do. But 10 years later, you pay me back the money based on the value in 10 years. Let's agree upon, let's say 27%. I'm just making up the number 27%. It could be 30%. It could be 31.25%, whatever that might be. So in this case, let's say 27%. So in this case, you need to pay me back. We agree to pay back 27% for that $100,000 that I put into the house. 10 years later, let's say assume the property from $500,000 become $1 million. So now John has to either sell the house or cash out, refinance, whatever that might be, take out $270,000 to pay off the equity share. So that is how it works. Now, do they look at credit score? Yes, they do look at credit score. But again, they look at credit score just to make sure that there's no criminals, there's no bankruptcy, foreclosure, none of those anomalies. But if your credit score is very low due to missing payments and things like that, they're not too worried about that because again, it's not a loan anyway, but they just want to see what kind of people they're dealing with. Did I answer your question?
Yes, sir, you did. I got a lot of loans for this program. Thank you.
Okay, let me just make sure I understand it. Is this like an option on it for the future, or how? I mean, I'm trying to figure out how they would do that.
Give you today's money, but you pay them back in the future. So again, just imagine today, Cheryl, I invest a property together with you. Okay. So
and if they sell it before then?
Again, it's still 27%. So
okay, no matter when they sell it. No, when,
Right.
no matter. Okay, gotcha.
I mean, you can take my money today and you sell the property tomorrow. That's fine. You still pay me 27%. That is the agree
Gotcha.
upon, share, right? Okay, it's 9:15. We have 15 minutes past the hour. I don't want to keep everybody right here. I know that you guys don't want to leave, but again, it's it's another night. But again, thank you so much. If you have not following us on our Facebook, please follow on Facebook. We have a new support number. Any questions that you might have, feel free to text us. Please don't leave message because again, we don't have enough time to listen to all those messages. But when you text, we can see it immediately and respond to you immediately. Okay. Any questions that you might have, text us, send email to support, talk to us on Facebook, and we'll get back to you as soon as possible. So thank you, everyone. Good night.